Welcome back to the You Should Crypto channel, the channel where you learn about crypto to make better crypto investments. Today we are going to answer the question, is dollar cost averaging, value averaging, or lump sum a better crypto investing strategy? But before explaining the different strategies, you have to know that the strategy you will adopt will drastically change your potential gains. With this chart and the right strategy, you could make profits, but with the wrong strategy, you could actually lose money. And so today the goal is going to find the right strategy for your needs, because all strategies are not applicable for the same situation. Let's take those two charts for example. Here I rank the performance of the three strategies we are going to cover today based on the market structure you can see on the right. So in the first example, we can see that the market is going up steadily, and for this example, the lump sum strategy is the best. But if you look at the chart underneath it, you can see that it is a sideways market, and that the lump sum strategy is now the worst performing strategy. So it really is important to understand the strategies you use, because based on the market structure, you're going to have different outcomes. Now, dollar cost averaging, value averaging, and lump sum investing are pretty well known concepts. They have been popularized by traditional finance, and people are taking the lessons from traditional finance to apply the same concepts to crypto. But the problem is the rules are different for crypto. If you invest in crypto with the same strategies you use for traditional finance, you're pretty soon going to realize that this is not a good idea. And I learned it the hard way. To give you my experience on the matter, I invested in a coin that is called ICP, and I used the wrong investing strategy for that coin, and that led me to have a minus 50% in my portfolio, something that could have been avoided if I used another investing strategy. And so after this video, you will be able to choose the right investment strategy for your needs to avoid the mistakes I made. So how do dollar cost averaging, value averaging, and lump sum work? Well, first of all, what is the goal of an investment strategy? The goal of an investment strategy is to maximize growth for a given level of risk in a consistent manner. So truthfully, all strategies work, but they're not equal. So now we are going to understand what those three strategies are, how they work, and which one is the best. Starting with lump sum investing. Lump sum investing is investing all your money at once instead of spreading it over time. For example, if you have $2,400 to invest, you would invest the full amount the first month. And on the scale of a year, the distribution would look like this: $2,400 the first month and $0 for the 11 months remaining. So with this strategy, because you invest everything at once, your average buying price is going to be your first entry, because, well, there is no other entry than the first one. So this is the most simple strategy, as it is not really a strategy. It is buying everything at once and waiting for the market to give you returns. But let's look at an example to understand it more clearly. So we are going to have multiple categories. We're going to have the number of months, the Bitcoin price, the amount you invested, the amount of Bitcoin you got, and your average buying price. Let's imagine on the first month, the Bitcoin price is $30,000. You invest $3,000, and so you get 0.1 Bitcoin at an average price of $30,000. On month 2, the Bitcoin price drops by $10,000, so it ends up at $20,000. Since you're using the lump sum investing strategy, on the second month, you do not invest anything, and so you get no more Bitcoin. And so because you didn't buy anything, your average buying price is still $30,000. So because the Bitcoin price dropped, you are now losing money. On the third month, the Bitcoin price goes up by $5,000. So the Bitcoin price is $25,000. Because we adopted the lump sum strategy, we do not invest any more money, and we do not get any more Bitcoin. So our average buying price is still the same. And here comes the problem with lump sum investing. Because we bought Bitcoin at its peak, we are now losing money, and so lump sum investing has a high risk of having a bad entry. But this strategy is still used by a lot of people. So what are the advantages of lump sum investing? Well, you get full exposition to the market right away, meaning if the market does go up when you invested your money, you are going to get more money because you are exposed with 100% of your capital. This strategy also has the potential to give the highest returns. If you do manage to buy when the price of the crypto is at its lowest, you are going to capture the upside with 100% exposure. Lump sum investing also gives simplicity of management. You buy once and then you don't have to do anything. It allows you to avoid opportunity cost issues, because if you wait to invest your money is going to be eaten away by inflation, and you might have other things to do with your money than leaving it at the bank. Plus, lump sum investing is more efficient when it comes to fees, because every time you make a transaction, you have fees, and so by only buying once, you ensure that the major part of your capital is directed towards growing and not management fees. Now, what are the downsides of lump sum investing? Because there are some. As we discussed, a bad timing can be very painful. If you buy the top and then it crashes, you might spend a month in the red. or even years sometimes. And so because you have your full capital allocated, you have to be able to stomach volatility, because you are going to see big swings in your portfolio value. The main downside to lump sum investing is that there is no way to improve your average buying price. So if you made a mistake by buying at the wrong moment, you are going to suffer the consequences of that. Next, this is not really a downside, but it is additional work. If you're going to invest all your money at once, you need to make good research before it and build a strong conviction, because once the money is in, you are trapped if it goes bad, and so there is no flexibility for new information. If suddenly the project you thought to be good reveals itself to be bad, then you are trapped. So what is the alternative? Well, dollar cost averaging, or DCA. This investing strategy is going to fix all the downsides of the lump sum investing strategy. So dollar cost averaging is investing a fixed amount at regular intervals regardless of market conditions. You would, for example, split it to invest it over a year, and so this would amount to $200 a month. Here you can see the distribution. We have 12 months in the year, each month is $200 and it equates to $2,400. And here is the main difference with lump sum investing. Lump sum investing had a fixed average buying price, but with dollar cost averaging we smooth out the average buying price. And so if the first time you enter the market happens to be a bad timing, then it is not as big of an issue than it is for lump sum investing, because with dollar cost averaging you can just modify your average buying price. But to make it easier, let's take an example. So same example than before, but using a different strategy. On the first month, the Bitcoin price is $30,000, and because the example is 3 months long and we have $3,000 to invest, the first month we are going to invest $1,000, which will get us 0.03 Bitcoin, and our average buying price is going to be $30,000. On the second month, just like the other example, the Bitcoin price drops by $10,000, so you would now be at a loss. But this time you invest another $1,000, and for the same price as month 1, you get more Bitcoin because you now get 0.05 Bitcoin. Combining the two purchases, our average buying price goes from $30,000 to $24,000. So this would mean that for us to be positive on that position, we would need to exceed $24,000 and not $30,000 anymore. Going on to the third month, the Bitcoin price surges by $5,000. You invest another $1,000, and because the price rose, you can buy less Bitcoin than you did for the same amount in month 2. So you get 0.04 Bitcoin, which will raise your average buying price a little bit. And this possibility to modify the average buying price is the power of dollar cost averaging, because it mitigates the risk of bad entries. Had you invested the full amount the first month, you would be negative by a lot, but here you are only $670 in the red. So to summarize, what are the advantages of dollar cost averaging? Well, it reduces the risk of bad timing, as we just discussed, but it also reduces the stress linked to volatility, because if the market turns against you, you know that you can do something to limit the damage. Dollar cost averaging also removes the need to time the market. You don't need to analyze the market, you just need to invest the same amount every given time, and by math principles your risk will decrease without you even doing any work. Now another big part of DCA is that it reduces the risk of psychological mistakes. When you have all your money invested and the market goes down, you might be scared because you are losing all of your money, and so you might panic sell, something that you shouldn't do because it will trap you in the low end. But with DCA, because you have lower amounts invested and you are adjusting your buying price every time, it does not feel as scary. Plus it is easy to automate. You can set up an account so that your money gets invested every month automatically without you doing any work. Now, what are the downside of dollar cost averaging? Because there are some. Well, the first notable downside of dollar cost averaging is that the risk reduction comes at the expense of higher returns. So if you adopt that strategy, you choose not to have the highest returns but to have a safe path. Another downside of dollar cost averaging is that because you do not have your full capital allocated to the market, when there is a rally or an upward trend, you will have a very slow growth because while you only have a portion of your capital allocated. One thing you should be aware of is that your smoothing power decreases over time. The further you are in your DCA program, the harder it is going to be to move your average buying price. So if you've been dollar cost averaging for a long time, it might not be as converting. Another thing is that it might not be the cost of opportunity. While your money is sitting waiting to be invested, it is losing value. And so maybe the wait is not worth the decrease in value. And lastly, and this is the opposite of lump sum investing, because you invest more frequently, you are going to have more fees. And so by default, a bigger portion of your capital will just go to waste. Alright, let's go on to the third option. And that option is value averaging. So what is value averaging? Value averaging is investing different amounts at regular intervals to grow a portfolio at a steady pace. And so for example, if you want your portfolio to be worth $2,400, you are going to spend a variable amount of money each month, depending depending on the market condition. So this is a random example I made up, but essentially each square represents 1 month, and so you can see that the amounts invested vary a lot. All that's to be worth $2,400 in the end. And we are going to look at an example in a minute to understand it better, but essentially when the market is going down, as you can see on the left, you are going to invest bigger amounts, and when the market is going up, as you can see on the right, you are going to invest smaller amounts. And the goal of value averaging is to maximize dollar value. So with value averaging, the goal is not to have the biggest number in your portfolio, but to have the biggest return on the capital you invested. Essentially, value averaging is made for efficiency. So for example, this one is going to be a bit different. So we still have the month, the Bitcoin price, but here we have the target value. The target value is the value we want our portfolio to be at a certain time. Then we have the amount invested, our portfolio value, and our average buying price. So in the first month, the Bitcoin price is $30,000. On the first month, we want our portfolio to be worth $1,000. So because we haven't invested anything, for it to be worth $1,000, we have to put in $1,000. And our average buying price is going to be $30,000. Now let's imagine the market fluctuates and the money we invested is now only worth $666. So on the second month, the Bitcoin price would be $20,000. Our target value would be $2,000 because we want our portfolio to be worth $1,000 more each month. And this is also called the value path. The value path is the value you want your portfolio to be every given time. So because our portfolio value is now $666 and we want it to be $2,000, we now have to invest more than $1,000. We'll have to invest $1,333. We can also see that by combining those two purchases, our average buying price decreased, going from $30,000 to $23,000. Now we are going to go to the third month, and let's imagine the market fluctuates. So now our portfolio value is $2,500. So this equates to a Bitcoin price of $25,000. Because the value path is linear, on the third month we want our portfolio value to be $3,000. But because our portfolio value is already worth $2,500, we only have to invest $500. And this is the essence of value averaging. When the price is going up, you buy less, and when the price is going down, you buy more. And by doing so, you maximize the amount of Bitcoin you can buy. You can also see that we lowered our average buying price. With the same Bitcoin price fluctuation, the two previous strategies were negative, but this one is making money. Alright, so to summarize, what are the advantages of value averaging? Obviously, you buy more when the price drops, so it improves your average buying price. It helps you capture volatility instead of suffering from it, because your investments will vary depending on the market condition. And it also makes your portfolio grow at a steady pace. And that is because you have a value path. Every given time, you choose the value you want your portfolio to be at. And value averaging is more capital efficient than DCA, because dollar cost averaging isn't modular. But there are some downsides with value averaging. It might seem all perfect for now, but it is not. First of all, it is more complex to use. Obviously, you have to calculate each time the amount you're going to invest. And it also requires monitoring. So it is not a strategy you can adopt and forget. It requires quite a bit of work. Now, one of the main downsides of value averaging is that it is cash demanding in prolonged bear market. Because we buy more when the price goes down, well, if the price continues on going down, there will come a time where you cannot keep up with the amount of money that strategy demands. But this strategy also underperforms in bull markets. I did not mention it already, but to stay on your value path, you invest the difference between your target value and the value of your portfolio. But if the market goes up a lot, it can happen that you already exceed your value path. And so you would sell the portion of the assets that exceed your value path to stay on your value path. And it gives you spare cash for further buys. But the problem with that is that if the market goes up a lot, you're going to overshoot your value path. And so you're going to sell more and more and end up underexposed on the market. And lastly, this strategy is harder to automate as it requires calculation and not all platforms propose it. So given all that we said, what is the best strategy? Well, you saw it coming, but there is no best strategy. It all depends on the type of market. As a rule of thumb, when the market is in an uptrend, you would prefer to use lump sum investing. But when the market goes sideways, you would prefer value averaging. And dollar cost averaging would be when you're in an in-between, or simply when you can't decide. Dollar cost averaging is the best of both worlds, and it is also the no hassle option, as it is easy to use and you can use that strategy in every market condition. Now, there are a lot of people who say that lump sum investing is the best option, but those people mostly come from traditional finance, where this is true. But the game is different in the crypto sphere. So now we are going to see what the difference is and what you should do to avoid mistakes. But before that, I have to tell you that my channel is made for you to learn how to increase your crypto gains. So if you find a lot of value watching my videos, subscribe to my channel. This will push me to create more content and so help you even more. Alright, so what is the difference between traditional finance and crypto? Well, the main difference is the market structure. On the left, you can see the chart of the S&P 500, which is the index of the 500 biggest companies in America. And on the right, you can see the chart of Solana, which is currently the 6th largest cryptocurrency. I chose those charts because they represent really well their space. For traditional finance, you can see that the market is mostly going up and there is low volatility, which is not the same for crypto, which is way more volatile and does not go up the same way as traditional finance. So yes, for traditional finance, lump sum investing is the best strategy because you could have bought at any time on the chart and you would have made money. But had you done the same thing with the crypto chart, you would have lost money. But this is not true for the crypto chart, which is on the right. So for the crypto industry, dollar cost averaging and value averaging are also options to consider. So we saw that the crypto market is more volatile than traditional finance. But what is the problem with that? Well, because the market is more volatile, you have a higher chance of having bad luck, because there are going to be more peaks you might not recover from and the drawdowns are going to be harder. Plus, in the crypto market, most of the gains are made in a few days. So in a year, 365 days, let's imagine a crypto went up 50%. In those 50%, maybe 30% have been made on 2 days. And this comes to wipe our theory that dollar cost averaging and value averaging are a good option. And that is because you have a higher chance of missing the upside if you are underexposed. So if you DCA or if you use value averaging. So on one side, you do not want to put all your money at once not to make a mistake. But on the other side, you want to put all your money at once because you don't want to miss the upside. So what is the solution to solve the crypto market? The solution I found is short-term dollar cost averaging, and this strategy will help us improve the risk-reward ratio. How will it do that? Well, it will reduce bad timing risk, because if you spread your buy orders over time, you reduce the risk of putting all of your money at the top. Plus, since it is over the short term, the strategy does not leave you underexposed for too long, so you have less chance of missing the big days. And yes, this method won't ensure you to have the biggest potential gains, like lump sum investing could, but we are not speculators, we are investors. And investors seek reliable methods to make profits consistently. Now, the main difference in market structure between traditional finance and crypto is volatility. And this is why we use different investment strategies in traditional finance and crypto. But volatility also varies amongst the crypto industry. So you also have to adapt your investment strategy to the size of the coin you invest in. Because the bigger the coin, the less volatility. And the smaller the coin, the more the volatility. So as you can see here, we have a Bitcoin chart and we have a PancakeSwap chart. PancakeSwap is obviously way smaller than Bitcoin, and so it is subject to more volatility, as you can see on the right chart. And for that reason, lump sum investing is going to be way more acceptable on the Bitcoin chart than it would be on the PancakeSwap chart. And so as a rule of thumb, the bigger the coin, the less risk you take by using lump sum investing. But for smaller coin, you might prefer dollar cost averaging, as there is more risk of getting trapped, as there is more risk of buying the top. In between those two strategies lies short-term dollar cost averaging, which is the best of both worlds. But now let's add another layer of complexity to make sure we maximize our gain while reducing the risk as much as possible. Dollar cost averaging is done through a certain period of time, but depending on the size of the coin, you might want to shorten that period or expand it. As a rule of thumb, for small coins, you might want to adopt a longer dollar cost averaging strategy. And that is because the smaller the coin, the less chance you have of getting your money back if the market turns against you. And so by adapting the time frame of your dollar cost averaging, well, you reduce your risk as much as possible, but you still try to get the maximal upside possible. Alright, on the previous diagram, we talked about lump sum investing and dollar cost averaging, but where is value averaging? Well, unfortunately, value averaging is not the best option for crypto markets. Value averaging is useful if you have a target value, so if you absolutely want your portfolio to be worth a certain amount. But because by design, value averaging gets you unexposed to the market when there is a parabolic upside, well, this clearly doesn't make it the best option for cryptocurrencies, because the sole promise of cryptocurrencies is to have parabolic upside. So like we just said, value averaging cuts off parabolic upside. Plus, because the crypto market is highly volatile, price movements are very violent, and so the coin you bought can go down a lot, meaning to follow the strategy, you might have to buy a lot at the same time, money that you might not have as it might make big amounts. So what are the actionable takeaways you can have from this video? Well, I am going to tell you what strategy you should adopt based on your profile. First of all, lump sum. The lump sum strategy is for those who have a long-term vision, people who have strong conviction and are unemotional. It is also for people who want to take the risk to have the maximum potential upside. Bear in mind mind that this strategy is best suited for large cap coins. Now, dollar cost averaging. Dollar cost averaging is for risk-averse people, so people who hate to lose money. This strategy is still for people who have a long-term vision, but it suits better people who are emotional. Dollar cost averaging is for people who want to ensure gains, regardless of the fact that the gains are not maximized. Dollar cost averaging is very versatile. It works for all types of coins, from small caps to large caps. Now, value averaging. Value averaging is for people who are conservative. It is for people who want certainty, and people who have a steady income. Value averaging is best suited for mid to large cap coins. The goal of my channel is to help you increase your crypto gains through education. So if you want to increase your crypto gains, I would highly recommend you subscribe to my channel. And if you want to learn more, you can go watch my last video where I answered the question, should you invest in Bitcoin or Bitcoin treasury companies? I will see you in the next one.